Hey everyone, welcome to the Mobile User Acquisition Show. In the Mobile User Acquisition Show, we talk about how to use mobile user acquisition strategies to grow your app quickly and capital efficiently. The Mobile User Acquisition Show is presented by me, Shamant Rao, mobile growth leader and founder and CEO of the mobile growth consulting firm Rocketship HQ. Each episode includes strategies, tips, and pointers from the leading edge of mobile user acquisition that you can use to unlock tremendous growth for your app in a sustainable and capital-efficient manner. Our guest today is Mark Loranger, co-founder at Braavo Capital. Today, we dive into the different financing options for every company and how VC funding isn't the only option available to app developers. In fact, we'll talk about how VC funding might actually be a bad idea for very many types of businesses. We'll look at how app developers should think about their financial decisions and planning in the wake of the upcoming changes to the app economy, starting with iOS 14 and IDFA deprecation just as well. I'm very excited to welcome Mark Loranger to the Mobile User Acquisition Show. Mark, welcome to this show.
Shamant, thanks for having me. I'm excited to be here.
Yeah, I'm thrilled to have you because certainly financing is something that's so critical to very many app developers. And this is something you've supported very many app developers with, especially the smaller ones for whom the app business can be a ticket to growing and scaling what could be a fully scaled business, right? And certainly financing can open up a lot of doors for small independent developers. And certainly you have a window into how that world operates. So I'm thrilled to dive into all of that with you today.
Sure. Speaking broadly, to kind of address that, the reality is every business needs capital to grow, right? You can't build a business without capital. Now, if you have a skill and expertise in a particular area, and you can use what's called sweat equity to build something, whether you're an engineer building an app or whether you're a landscaper and you're just working on your own time, that has value, right? And so there's value that is either capital or time. I would argue that both sort of, in most people's lives, both have some sort of a way to measure. You need money to grow a business, and you need different types of money at different times. And certainly, we see sort of the entire spectrum because we do work, as you said, with very, very early stage companies, as well as very mature businesses. And so there's a huge spectrum, and certainly, capital and fundraising and money to build businesses, there's no one size fits all solution. So I think that's like an important context to share. Yeah.
Certainly. And we will talk about that entire spectrum during this conversation. Mm-hmm. But let's say there's an app developer, they have an app out there, the app's kind of growing and scaling. At what point of time should they start thinking about funding and start to explore their options?
Yeah, that's a good question. So if the app is already in the market and already starting to grow, right? Scaling generally means acquiring users and in ideal circumstances, monetizing. But that's not always the case, right? You could acquire users and not monetize. That's a different strategy. I think that fundraising is always contextual on what you're trying to accomplish as a business, right? For some entrepreneurs, they want to build billion-dollar companies, right? And so the earlier you can raise larger sums of money, the better off you are because you can attack a market opportunity faster. However, that comes with a major trade-off, and I think that's really the question that most entrepreneurs should ask themselves very early on in the process is, what am I trying to build? And what is reasonable about my goals and my aspirations? What are the trade-offs I'm willing to make about quality of life, about the likelihood of outcomes for my business, about what is most important for me? And I think those questions actually precede any sort of funding decision, right? Sure. If you are trying to build a massive, massive company, then you may as well just go try to raise as much equity as possible. But you may not be successful because that massive company may not be possible. You have to be realistic about the market and about your ability to execute against market opportunity. But without sort of, giving this philosophical perspective, what I would say is, as soon as you have some metrics, as you said, as soon as you're starting to see some scale, I think it's worthwhile to evaluate what options are out there. For entrepreneurs, app founders, you're one of your core responsibilities to your organization is to create optionality. Optionality means having different sort of options for whatever the next phase of the business is, depending on the circumstances that you're in. And optionality in the case of funding is what types of funding opportunities are available to me, and how do I value those funding opportunities? And so, for companies that have a little bit of traction, certainly there is the equity path, but that comes with a lot of trade-offs, and you may not be successful. There's also, in our case, revenue-based financing. As soon as you start to generate some revenue, that traction, and you can seek revenue-based financing to grow your business. There's a few different types of revenue-based financing out there. Braavo offers a couple different products, factoring or working capital financing, receivables, lines of credit. Those are all things based upon money that you've earned, but you haven't necessarily been paid, whether it's by the app stores, the ad networks. There's also user acquisition funding. If you have good metrics, and obviously this is our world, if you have good metrics for LTV to CAC, you have strong retention, you're improving your downstream events to sort of create more value in the long tail of your user's journey, then in that case, you can actually qualify for user acquisition funding as well, which is based upon the likelihood of revenue being created in the future by your user acquisition activities. Other than that, for relatively early companies, occasionally you can get lines of credit at your bank. Usually those comes with a lot of strings attached, personal guarantees, things like that. In Europe, more so than the US, there may be government programs that you can get. Whether there's in some countries, there's a strong sort of program for gaming funding for gaming, because they're trying to build a gaming ecosystem. And so, in your local jurisdiction, particularly in Europe, I think the government funding path is also an opportunity. But again, there's a lot of process that goes along with that. And so, what I mentioned earlier is sort of an entrepreneur's most important value is time. And so if you're looking to save time, going down the path that's going to take you 2 or 3 or 4 months to find out if you're actually going to get that funding, that can be disadvantageous. And that's why platforms like Braavo and others out there have emerged to provide funding for early stage app companies very, very quickly, so you can execute an opportunity. Does that answer the question?
Yeah. And that also helps me see what the very different options are for a developer, that might be looking to really fuel the next stage of their growth. And, for the vast majority of entrepreneurs, or, for the lay people at least, when they say funding, they're like, oh, it's VC funding. That's the first reaction that a lot of people have. So what sort of apps is VC funding right for, and who should be pursuing it?
Yeah, well, the VCs are better suited to answer what sort of apps are right for them. But I think what we can see from the market is generally it's very challenging if you've just got a consumer-focused app with even subscription monetization to raise large rounds of VC funding, because it's an extremely competitive market. There's really, really dominant players at the top of every category. And to sort of attack their position is going to be very, very expensive. And particularly with consumer products like apps, it's really hard to build a tremendous amount of enterprise value in the form of users, because users generally churn out from consumer subscriptions. Like there isn't, when VCs love B2B SaaS, because you hold on to users for years and years, and they actually get more valuable over time. It's difficult in consumer subscriptions to maintain those same sort of increasing value on a per user basis. You have to find other ways to monetize. Maybe you go off app, so you have a multi-platform business model. But it's a real challenge right now to raise meaningful venture capital in the app world, unless there's something that you've built that is extremely unique, that is also very scalable. I'd like to argue that there should be some sort of core technology component that gives you an unfair competitive advantage. That's usually where the VCs get excited. There's some unfair competitive advantage. Or the other thing is you've somehow cracked the code on virality, and you're exploding. And in that case, there's people will throw money at you, even prior to monetization, and so I think, obviously there's a few examples in the market of companies that have sort of just come onto the scene and grown really, really rapidly. And, TikTok is one that sticks out in my mind, obviously.
Sure.
And so, there's always a chance for that sort of a viral growth to get VCs excited, but otherwise there should be something really, really unique and sort of some long-term competitive advantage you can create through technology or through
Sure.
some unique vision that you have for the business. So, I don't know if I'm giving a direct answer, but I'm not a VC, so their answers may vary.
Sure.
And then gaming is really a different world. Gaming is there's just not a lot of VC funding, traditional VC funding going to gaming. Although there are some specialty funds with gaming people behind them, people that come from the gaming industry that have done specialty gaming VC funds, but
Sure.
those would be the only ones that would probably be suited to answer, what's fundable in the gaming world.
Certainly. So it sounds like VC makes sense if you feel like you need a large amount of capital to really go very, very big.
Yep.
Right? And a lot of the alternative means of financing allow you to scale. They don't necessarily need you to go become a $1 billion company.
Right.
Yep. You can grow month in and month out and see steady scale and growth with some of the things, options you mentioned, factoring, revenue-based financing, or user acquisition funding. So with these modes of funding, what are some of the trade-offs or challenges that an app should be mindful of if they seek out, let's just say, a non-VC mode of funding?
Yeah, so I think that the non-VC path allows entrepreneurs to continue to have the optionality that I talked about before, because taking a different type of funding, some non-VC funding, doesn't limit your ability to take VC funding in the future. However, if you take VC funding early on, then you are forced down a path of trying to create venture scale, which means, $1 billion potential enterprise value, which is very, very hard to accomplish. And most companies fail at creating venture scale. And therefore the outcomes for founders are relatively binary. It's either a massive outcome or it all goes to nothing, because the VCs are looking for the 1 in 10 from their portfolio for really massive returns. As soon as you go down that path, your options change in terms of what you can accomplish as a business. But let's talk about the other option, which is this revenue-based funding, or any type of non-dilutive funding that is not requiring a lot of equity, a lot of your company in exchange for that capital. Generally, these types of fundings are a little bit more conducive to sustainable business models. Revenue-based financing options, we mentioned a few different types. Generally, the platform or the company that is providing that funding, their goal is to make sure that they get repaid. Now, ideally, the company is able to grow. And so, for anyone who's providing this type of funding, you want these companies that take your money to grow and then take more, right? Like that's the ideal circumstance, but it's a kind of a shared success model, right? The more a company grows and is taking revenue-based financing, the more capital they can take, and they can be successful, but also the platform providing that funding can also be successful. The trade-offs are, in some cases, you don't know how much money you'll be able to get over some course of some period of time, because it's based upon execution, right? Like if you can't execute, if you can't effectively spend that money to grow your business, then you're not going to qualify for more funding. You're not going to get that next chunk of money from that revenue-based financing platform, because you haven't been able to execute against your vision. But the alternative is you took a huge chunk of money from VCs, you didn't execute against your vision, and then your business is gone, right? So like the trade-off in context is not so bad. I think that other trade-offs might just be that you can't grow as fast as you might like, right? There is a lot of allure to raising millions, if not tens of millions of dollars in a single pot, right? Because then you have ideally 18 months to do whatever the heck you can to get to that next level of scale. But again, if you don't get to that next level of scale, whatever you promised your investors to say, I'm going to get to 10x where I am today, if you don't get there, your investors are disappointed. They're unlikely to continue funding your business. And then you have to rethink your entire business model and say, well, how do I change my business model entirely? Or maybe your investors have a lot of control and they force you to just spend as much money as you can to hope for that last hurrah of success, that miracle of all of a sudden your retention doubles in day 30. and then you have a business that works, right? So trade-offs, you know, it's a limiting factor on the amount of money you have for the long period of time.
Sure.
You know, you have to, in some cases, ask for more capital sooner than you would from raising a big round of funding, but you're also maintaining that optionality. And you know, I believe it forces entrepreneurs, founders, to think about sort of the fundamentals of their business all the time. And when you don't think about the fundamentals of your business all the time, if you just focus exclusively with a bias on growth, you can lose sight of what works about your business model. And maybe it doesn't have venture scale, but maybe you can create a great profitable business and be very, very happy and successful and work 4 days a week. You know, one of our earliest clients, you know, their business grew really, really exceptionally. You know, they bootstrapped. They got to a point where they're ready to take on, non-dilutive funding, and they've grown to 700 or 800K a month in revenue, and they have a very comfortable work-life balance. And they don't have investors telling them what to do. They can work on side projects. You know, can you imagine that your business is making $600,000 or $800,000 a month, and you're working on side projects because you just built a profitable, fundamentally sound business with good product, with good marketing, and that's not so bad, you know. And in a worst case scenario, and you want to sell that business has real value, you know. And so there's you don't have to sell it for $100 million to be really successful because you haven't sold any of your business along the way.
Yeah, and which comes down to what you said earlier, Vic, about how a developer or a business owner really needs to figure out what they want out of the business. You know, if they do want to build $1 billion business, work 7 days a week, that there is a path for that. And what you're also saying here is that isn't the only path, which I think is important to underscore, because in certain circles, a lifestyle business can be a bit of a dirty word. And what you're saying is underscores that it doesn't have to be. Yeah, absolutely.
God, no. I mean, look,
Yeah.
If you build a lifestyle business yourself, you don't raise outside capital, and maybe you get to, let's say, a $3 million annualized business, right? So 250K a month in revenue, which is very, very doable in the app world. And so long as you have good fundamentals of your business economics, you could sell that for $15 million, maybe $20 million, you know, if you've got good growth. And you haven't sold any of your business. You're immediately a very wealthy person, and then you name whatever it is that you do next. You can't sell a business for $15 million and take any money away if you've raised 5 or 10 from VCs, because they get all the money back. You know, so you know, again, it's not to trash on the VC business model. Like, we have raised venture capital ourselves, you know, but we are a B2B company. We retain our customers for a long period of time. We've created a tremendous amount of enterprise value and sort of the infrastructure we've built, but it's also taken us several years to get to where we are. A lot of hard work, a lot of trade-offs, and work-life balance, and all those things. And when I look at a lot of our customers who are just building profitable business models, I say, next time around, maybe I'll think about that pathway as a different approach. You know? Yeah.
And certainly, I'm certainly familiar with VC-funded business that sold for tens of millions of dollars and yet didn't return a lot of money to founders or early employees, you know, and they went for it. And, you know, you're right. You know, certainly that doesn't have to be the only path that an entrepreneur can take. Yeah. To switch gears, go ahead, please.
Yeah, I was just going to say, in any case, and this is something important to just reiterate, that even if you do take venture capital, or even if you expect to take venture capital, taking a different form of funding that's non-dilutive can extend the amount of time that you have between funding rounds or until you need to raise money. So it's a runway extension. You know, if you've raised a small seed round, let's say a couple $1 million, which is a decent seed round, you know, that money should be allocated to building enterprise value. I talked a little bit earlier about enterprise value. You're building technology, you're hiring great people, you're creating competitive advantages. That's where your money from equity should go, because you're creating long-term value. If you have sources of non-dilutive capital to go alongside of that equity, you can use that to invest in marketing, for example. Marketing should repay itself if you've got decent marketing channels in a meaningful amount of time that you can have good economics on even the capital that you're borrowing. And you're essentially subsidizing your marketing budget with non-dilutive funding while you allocate all of your equity to the stuff that creates that long-term value. You stretch out your runway, you just build more on less. So again, these things can be complementary, but they don't have to be sort of, they're not mutually exclusive in any case. But certainly once you go down the VC path, the outcomes that are potential change a lot.
Yeah. And what I'm also hearing you say is that with non-dilutive funding, you can use that for operating expenses or variable expenses, which are important and necessary, but aren't necessarily building the longer term value, which can be making the business really valuable.
Correct. You know, and that's an important thing to keep in mind.
Yeah. And let's say there's an app that's hit a spurt of growth. Maybe they're crushing it on TikTok. Maybe they just went super viral. They're like, okay, we see we're making a bunch of revenue. Let's go get non-dilutive funding based on this revenue. Mm-hmm. And then they're like, oh, 2 months down the line, our retention's terrible. So that's a very real possibility. And, you know, certainly I'm familiar with apps, and I imagine you are too, that could fall in that sort of category. For an app developer who has a spurt of growth and is wondering, oh my God, is this sustainable? Should I raise funding? Because maybe I'll raise funding and things will crash. How should they recommend thinking about financing if they are in that position?
Well, honestly, in that circumstance, the lowest risk type of funding would be factoring, because essentially you're just you're getting access to your earnings that haven't been paid sooner. If you're growing really fast, getting access to those earnings sooner, you can reinvest. If you're reinvesting every week in that really, really rapid sort of revenue growth, then your marketing budget, if that's where you're spending your money, can increase every single week, and you can create non-linear returns. You can create compounding growth for as long as that sort of massive curve sustains. If that curve drops off, you haven't lost much, right? Because you've only leveraged your unpaid receivables. You haven't taken a lot more money that's going to have to get repaid over time, where if your revenue goes down, more and more of your revenue is going to go to servicing that longer term financing. Or if you raise VC at that point in time and then things go south, well, then you have to totally change your plans, and you know, in all likelihood, it's going to be very hard to recover from something like that. So, you know, if you have really, really quick early growth on a particular, you know, UA channel, in my mind, the best approach would be to leverage your receivables, because those are growing really quickly. Spin it right back into that platform and see how much it can scale, and then inevitably you're going to hit a plateau. Ideally, you don't drop off completely because your retention falls off a curve, but maybe it's just you can't scale any further on that platform. Maybe it's 100K, maybe it's 200K. At that point, you haven't necessarily committed to anyone else, whether it's a long-term sort of venture debt partner, whether it's a VC. You haven't committed to anything long-term to them, and you haven't leveraged money that you haven't yet earned, meaning that you're going to then have to pay something back that with revenue that's declining. That's really painful. So you know, I would argue that in that circumstance, any sort of factoring solution or you know, receivables based financing is the right approach if you're concerned about how viable something might be for 3 or 4 months. If you have really, really strong conviction that your retention is only improving and your metrics are just getting better, in that case, you know, I think that there's a reason to argue that you should focus on a longer term funding solution, because you're going to need more money in your war chest to really pour into that fire.
Totally.
In that case, there's you know, those other options, you know, long-term revenue-based financing or UA funding, or even, you know, VC. But again, in the case of VC, like, you really don't want to just raise venture to spend on marketing. You know, you should find other sources in that case. You know, the biggest challenge in that type of circumstance, and you've got experience in this, if you raise venture debt, it'll be a big number, right? They'll throw out 5 million to you or 3 million to you. That's if you have enough equity in the books to sort of support it. But you may not be able to spend all that. And then you're committed to a larger chunk of money that you have to pay for that you couldn't spend because you weren't able to scale into that opportunity. And so that's risky as well. Yeah.
So what you're advocating is, look, for somebody that isn't very certain about what even the medium term looks like, they can still be incremental around their financing decisions.
Absolutely.
And many of these alternate non-VC funding models let them do exactly that.
Right. They allow the company, the entrepreneur, to retain the control of decision making and to minimize their exposure to long-term risk because you're shortening the window under which you're sort of creating that leverage or that ability to spend. And one thing, there's a misconception about factoring or any sort of receivables financing, which is like, well, that's for companies that just need to pay their bills faster. The reality is, the majority of our customers over 5 years that have utilized the factoring solution are mid-stage or mature businesses that are just creating more leverage for themselves to incrementally grow, or to even, as I mentioned earlier, to create compounding growth, because they're repaying themselves so fast that investing every week and a little bit additional on your marketing budget, that'll really create a compounding growth. There's a curve there.
Absolutely.
Just from accelerating your earnings or just from leveraging your receivables.
Absolutely. To switch gears a bit, Mark, a lot of the funding decisions thus far in the last decade or so have been around user acquisition as a driver of a lot of app growth. For the vast majority of app-driven businesses, that's their single biggest expense line item. That has been the case in the last decade or so, just because that's the primary means of distribution, unless they go super viral, right? And all of that is set to change with the introduction of iOS 14 and the deprecation of IDFA. And generally what we are hearing and seeing is, and expecting, knowing what we do, is that advertising ROAS numbers are going to crash, ad CPMs are expected to crater, and some would argue that some of the smaller developers that benefited the most from direct response advertising are going to not find the direct response user acquisition nearly as effective. How should an app developer think about their financing decisions in this climate, where they're like, oh, a year ago, I would have invested $1 million a month without thinking about this. Yeah. I just don't know what's going to happen. How should they think about this?
I wish I had a great answer for you. It's a question we're asking ourselves. I think the entire industry is on its heels a little bit right now, trying to understand how we should think about the post iOS 14 world, and post attribution. Certainly the MMPs are trying to figure it out. Anyone that relies on mobile app growth and mobile app's ability to acquire users through paid acquisition are in a world of uncertainty right now. And whether like I can put a lens on, we've worked with so many companies over the years, I can kind of put myself in their shoes and think about how they're planning. I can also think about how we're planning, but I think in some ways there's similarities. It's really hard to price uncertainty. And so for an entrepreneur, pricing uncertainty means, what is the cost of making commitments for the long term when I don't know what that long term is going to look like? And making commitments might mean hiring your next growth marketer, or investing a tremendous amount in a new product or creative for an ad platform that you're not really, you're not certain you're going to be able to use in the future. I think from our perspective, it's how our customers are going to be able to continue to build their businesses with, we're taking a step back 5+ years, where it was a sort of a wild west of like, I'm spending money, I'm making money. Okay, that seems good, but really that's not a fundamentally sound way of building a business, right? So my recommendation in this case is similar to what I said earlier. For a company that's just started to hit some scale with a new ad platform or a new UA channel, but doesn't have any certainty that it's going to be successful in 2 months. It's the same situation here, which is I would be careful to rely on making really long-term commitments, to whatever plan that you had previously, and to whatever assumptions that you took into your modeling previously. I think that those assumptions need to be challenged at a really fundamental level. And it's not necessarily a bad thing to go back and challenge a lot of the assumptions you have about your business. Certainly if you don't know what new assumptions to put in place, it makes things really difficult. But I would say that, again, in the context of funding decisions, I would caution companies to commit to raising lots of equity with a goal and a plan in place that you believe will be driven primarily by user acquisition, because it's going to be, it's unclear, what that's going to look like. This is not to say I'm totally pessimistic. I think that there are certainly companies will figure out ways to be successful in the new environment, but it's going to take a little bit of time. I think on your previous podcast, the guys were saying, in 12 to 18 months, we'll figure things out. We'll know more. The new paradigms will emerge, not the short-term fixes that people are thinking about right now, but the long-term solutions. But this reminds me a lot. I mean, I would say in a less sort of globally impactful way is the pandemic, when it hit most seriously in February, March. We were thrown into this situation of uncertainty. And the question was, how do we plan for the long term? Most people were saying, well, look, you need to focus on the fundamentals. You need to try to find ways to just continue to create economic value in your business without necessarily committing to things that you won't be able to fulfill in a longer period of time until you have a better sense of how you're going to execute. So I think it's optimizing for shorter term commitments while you learn how your business will work post iOS 14. That's the best answer I can give. It's about being a little bit more conservative, probably, and certainly that's going to hurt my business if customers are super conservative, because they're not going to want money. They're not going to be comfortable spending money. But I think, again, in the context of long-term value creation, you just have to be a little bit conservative sometimes in committing to things that may or may not be able to sort of materialize once we figure out how to survive and hopefully thrive post iOS 14. But it's going to be a period of time where things go badly. If you are monetizing through ads, that's another area of challenges. And there's a discussion about, if you're monetizing through ads, how do you actually figure out how to monetize through IAPs in a very short period of time? In the context of what's happening. Do you make those drastic changes now, or do you at least envision them? Certainly, if you're going to do that, your revenue is going to drop off, right? Because you're going to have to, adopt a new business model. It reminds me a little bit of when companies that were, in health and fitness, for example, in 2015, not many companies, subscriptions were just starting to crack the surface of the market, and so companies transitioned from some blend of IAPs and ads to subscription business model. Their revenue dropped off dramatically for a long period of time before they were able to nail down the subscription models. A total different business model. So those things might happen in the not too distant future.
Yeah, it's going to be a period of transition. It's certainly going to be a challenging period for very many businesses. And I think your advice to play by ear, optimize for short-term wins and commitments, really, I think is spot on, because you don't want to be making a long-term commitment in the face of a very uncertain long-term future. So I think that is very good advice, Mark. And Mark,
I'm curious, Shimon,
ahead,
if you don't mind me asking, I'm gonna put you in the hot seat. What are you advising your clients? What's the advice you're giving them, or are you helping them plan differently? Like what's been your process with your clients?
Yeah, it's at a high level, it's very similar to the advice you did offer, which is wait and watch as to how the ecosystem evolves, but also make room in their technology roadmaps for significant retooling, because the MMPs as they are now will not function. They're all coming up with alternate solutions, right? So my advice has been, be prepared to retool all of your infrastructure, be it for MMPs, be it for SK ad network, and prepare, and of course, as you said, just prepare for a period of upheaval, which may or may not materialize, but my advice has been to prepare for the worst.
Yeah. It's tough. You want to stay optimistic, because
certainly
you like us believe in this ecosystem and invested all of our, a big chunk of our lives in helping create more and more businesses within this ecosystem, or support those successful businesses. So giving advice to be conservative is sort of counter to the optimism that I think we both have. But for a short period of time, being conservative again is not the worst thing. And it reminds me again of previous situations where if you relied purely on venture capital, for example, and you have committed to your investors that you're going to 3x your revenue between now and the end of the year, for example, it's going to be very difficult to execute against that. And so a more a more balanced blend of capital previously is going to put a lot of companies in a bit better position. And certainly something like revenue-based financing, where your repayment is based upon your revenue, sort of a rev share model. You've managed your risk effectively, because if your revenue goes down, your payments will go down. And so for us, like we're expecting that some of our customers' revenue goes down. It's going to take us longer to get repaid because we're getting repaid by some percentage of future earnings. And I think that in that case, that model, it's a shared risk model, and it's not as punitive to the company as if they were paying a fixed monthly payment to a different financing provider. Their revenue is cut in half. That means they've way more of their total operating budget is going to paying back a different platform. So anyway, that's just kind of a
certainly
more specificity around that. So
yeah, definitely, Mark. I know we have come up on time, so this is perhaps a good place for us to wrap, Mark. But before we do that, could you tell folks how they can find out more about you and everything you do?
So Braavo Capital Inc. is the name of my company. We can be found online at getbraavo.com. That's Braavo with 2 A's. So getbraavo, GETBRAAVO.com. You can also find us on Twitter at the same handle, getbraavo, LinkedIn, Facebook, all of the typical places where you'd find businesses like ours. Feel free to reach out to me personally on LinkedIn if you have any additional questions, or my email. You can find my email on the website as well. We are open and sort of still very, very optimistic and committed to empowering this ecosystem and the companies in it, even in times of uncertainty. So that's sort of the platform that we have.
Absolutely. We will link to all of that in the show note, and we'll have a full transcript of this episode. But for now, Mark, thank you so much for being on the Mobile User Acquisition Show. Really appreciate you taking the time.
Thanks, Shimant.
For more tips, pointers, and strategies from the leading edge of mobile user acquisition, subscribe to our YouTube channel right here, or check out our blog, rocketshipHQ.com/blog. Thank you.